with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for the Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, for listening to the show. We are on a number of different stations around, California, New Mexico, and Nevada. And all of these stations we've been with for a number of years. We're trying to add some new affiliates. If you want to see us, hear us, you can go to any of these radio stations, whether it's K-Ship out in Vegas or K-Mine down in K-Mine country in Albuquerque, New Mexico, KCAA in the Inland Empire in Southern California, as well as KMET, or K-Tahoe up in Central California area. Also, if you want to see us and hear us, go to YouTube, Jeff Barton, the Mortgage Voice. Go there, listen to us, see what we do. Try to understand that in this changing, challenging time that we have had, both in the economy as well as the mortgage industry, you know, if you're following rates, you know what I'm talking about. This is the place where you can get caught up with what's happening, whether it's on our daily Mortgage Minute or whether it's on the weekend show, Saturday and Sunday, driving around, going to the hardware store, tune us in. We can give you some advanced warning as to if the mortgage rates are going to go up, which I think they will. However, we have seen some movement the other way. Now, why is that? Why do rates do what they do? And I'm always asked that. Why are rates so high? Why are rates so low? When are they going to get low? Is this the lowest? What do you think I should do? The number of people who want to know the exact time to purchase, the exact time by which the rates are absolutely rock bottom, I can't tell you any of that, but I can tell you why things happen the way they do. And if you follow trends in the market like we all do, anybody who is a mortgage broker or is a banker or anybody who's really an economist, they watch long-term trends, and they usually do it from a historical perspective. You'll see what happened last week, last month, last year, the last 10 years, and you try to predict from that what's going to happen in the future. Now, we've seen times when the mortgage rates have gone up, and I grew up in a time where mortgage rates, you basically had to have 50% down to even get a mortgage. And this is back in the 50s and the 60s, right when mortgages were starting to become popular in order to buy a house. But many, and this is one of the reasons that real estate is always a great way to go when you're looking for investing long term. Whether the rates go up or down, your house will eventually make you some money. Most of the real estate millionaires in this country, or most millionaires in this country, did it through real estate. Everybody knows that about 90% of the real estate people who have made money are millionaires, especially in this particular market. Okay, so why things do what they do, and how come we can't seem to predict what's going to happen in the future? I'll predict this in the future. Rates are going to go up, even though, as I said, in the last week to 10 days, they have come down, and they have come down for a couple of reasons, right? The economy, inflation, the war, these three things are volatile, and they send markets crazy. Now, when I talk about markets, what am I talking about? Of course, the stock market. Whether it's the stock market here, the stock market in Argentina, the stock market in Russia or China or any of these places. Public markets to get funding in order to make a company grow, that's the basis by which all of these things happen. So market's been doing terrible. Anybody who's been in the market will tell you, you lose 4, 5, 6,000 points off of 35,000. Yeah, I mean, we may hit 29,000 in the next 30 days, which hasn't really happened in quite some time. I mean, we were busting out records 4 months ago in terms of the stock market number, the high, and everybody goes, oh, what's the Dow doing, or what's the Dow Jones Industrial Average? Most people, if they have their retirement money or their 401k money or a lot of different investments, they're in index funds. Let's face it, that's the safest way to go. Everybody does it. Most people who are my age, and that's a 65 and older crowd, they want to keep their money. They don't want to necessarily have to make a lot of money. If you're younger, yes, you want to make a lot of money. And anybody who is younger, and I mean younger, anybody under 40 years old, what was the biggest investment over the last 5 years? Crypto. Everybody knows that. Oh my gosh, crypto, it's this, it's that. I had an expert and I was talking to online, and they wanted to have me invest. I don't know. I get a lot of people that come to me wanting me to invest. Now, I don't know who told them I had any money. I don't. But they think I do because I have this radio show. Anyway, So they call me up, or they usually they IM me, right? And this person was so persuasive and charming, and I finally said, "Look, I really don't know anything about crypto. I've had a number of people on my show. Oh, you got a show? Yeah, I got a show. Will you come on the show? Absolutely. I can't wait to get on the show." So we went back and forth, back and forth. Finally, he said, "Okay, I'm coming on the show." Ghosted me. Never heard from him again. Now, why is that? Is it because crypto, or is it because of this guy? I think it's both. I think crypto is great if you're a gambler. I like Vegas. I don't gamble. I go there for the shows, go there for the food, get away, something like that. Now, I see people gambling at when I get up early. I do a lot of things in the morning. So 6, 7 o'clock in the morning, I'm strolling through the casino, and there's still people gambling from the night before, the day before that. It's in your blood if you want to gamble, and that's fine. But usually it's a younger crowd, especially in the crypto world. That's who the investments are. But for older people, 50 and above, let's say, you're going to want to have an index fund. You want to know what's happening. But what has happened over the past, as I say, week to 10 days, maybe 2 weeks, maybe a month, stock market has just taken a nosedive. So people who are invested in that take their money out of that and put it into U.S. Treasuries. It's affected the mortgage rate. Obviously, the investment in Treasuries is what they call the flight to security, flight to safety. Everybody wants to make sure that they're not losing their money. Well, with the inflation the way it is, and this is another funny thing about inflation, right? There is a yearly inflation rate, and everybody looks to that, and they look, oh man, it's 8%, 8.1%. But to know that inflation really varies month to month is a much more important gauge as to what's happening right now. So if I told you the inflation for April was 4.1% from the year previous, you might feel a little bit better about what's happening in the economy. But because we had 3 months last year spiking in inflation, October, April, and I forget the other month, like 15%, all the other months are averaged upwards. So over the 12-month period, you're never going to see that inflation rate go below 7.9, 8%. Why? Because you have these huge spikes. However, from March to April, you saw a 4%, 4.5% decline in the inflation. So with this happening in the stock market, people take their money out and put it into treasuries. When people buy treasuries, that causes the mortgage interest rate to fall. Everybody knows that. And we look at the 2-year and we look at the 10-year. We want to see that there is a divergent in that. We don't want to see those two numbers cross, i.e. the 2 makes more than the 10. We've talked about it ad infinitum on the show many times, the flattening of the yield curve, all that kind of stuff. Okay, so what is the 10-year doing? Well, the 10-year today is at 2.761. Now, 2 weeks ago, that was at I think it went up to 3.15, 3.14. Now, what does that mean? It means this is the yield that the government will pay you if you buy a bond. They will discount the bond so you're not paying 100% of what the bond cost is, and they'll up the yield that you get from the Treasury on a yearly basis. That has not happened recently because of the stock market and it's falling and crashing. Now, you've also got the war in Ukraine, which is weighing heavily on food prices worldwide. So there is obviously a commodity issue when it comes to the market as well. So money from commodities goes to the treasuries. This flight to security happens all the time. It happens in weather-related incidences. It happens in times like we are right now, where the stock market is failing. Now, what is the stock market going to do? Who knows? I don't know. It's less gambling than the crypto market, but if you're in index funds, they're going to go up 3-4%, 5%. They're going to go down 3, 4, 5, 6%. Over the long term, 20 years, you're probably going to do pretty well, anywhere from 8 to 10%. That's the average on most of these index funds. So all this means that it is a wait-and-see market when it comes to your mortgage interest rates. Now, I'm going to get into the mortgage interest rates a little later on in the show, just to talk about where we are now versus where we were, 3 weeks ago, 3 months ago, and before the pandemic. I'm Jeff Barton. I'm your voice in the mortgage industry. I really appreciate you listening each and every week to the show. It's interesting to get the comments from people who do listen. I actually have a few new people who are listening, who click on, hey, I like the show. And if you do go to any of these radio stations I mentioned, click on you like it. Join. Go to YouTube, Jeff Barton, the Mortgage Voice. Join what we're trying to do here, which is to spread mortgage information to you and the people around you. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Hey, if you want to see Malibu Funding, I keep saying that. If you want to see Malibu Funding, by the way, is the sponsor of the show, and I really appreciate what they do for us each and every week. For years, they've been sponsoring us. They're 7962, that's their NMLS number. I'm Jeff Barton. I do work for them as a loan officer as well, but for the most part, we try to make this show about you, about the audience, about bringing you information that can help you decide what kind of mortgage you want to get. And in regards to that, themortgagevoice.com is our website where you can see and hear the guests that do come on the show, as well as find out a little bit more about what we do for you as the borrower by bringing information. Along those lines, we bring account executives and all kinds of people from lenders to talk about mostly programs and what they're offering today, and what really are some of the solutions available in the marketplace to that end. Kim Tran joins us from AM West. Kim, how are you?
Yes, good. Thank you, Jeff. Thanks for having me on.
Thank you very much, and thanks again for doing this. I know sometimes the account executives, maybe not you, get a little bit nervous, but I do appreciate you coming on.
I do get nervous, but I get good coaching from you.
Oh, thank you very much. Okay, let's talk about the market. Now, we've seen rates improve a little bit in the last few days, but we've seen an upward trend in rates, and that really affects people's choices in the marketplace. What are you offering at AM West that might address some of these things?
Yeah, same thing. Jeff. Like as back as end of last year, we know that rate hike is coming. Just that we didn't know it's going to be this quick,
right?
This much, this short. I'm seeing slow down on like agency loans, governments, the full docs. But on the other side, our portfolio product has been picking up. Now you still have these clients who maybe weren't able to find a house, couldn't compete. Now's their chance. And what we're selling a lot is mainly, we do have maybe 6 different portfolios.
Okay.
But the one I see selling the most would be the VOE program, which we don't qualify with tax returns or pay stubs, no 4506. Mainly just qualify with just the written VOE with last 2 years' income. And also the same program is for self-employed. We just qualify off of the P&L.
Okay. 2
years business license, and a CPA letter. 2 other programs that's been the hot seller, and I don't know about your clients, but there are a lot of Californians maybe moving out of states,
right,
buying investment homes in the states.
Yeah.
We have 2 other programs which we call no ratio. These actually loan officers, brokers, as long as you are licensed in your home states, you can do about 30 other states without needing a license there.
Wow.
And the first one was actually pretty familiar in the market already, which is, no income, no employment, no ratio. All we qualify is just with the gross rent. And these 2 are just for investment only.
Right. Those are those DSCRs, right?
Yeah, DSCR, yeah, that's actually the term.
Right.
Yeah, we call that MS Advantage. Then there's another one who sometimes you may have clients who buy in certain areas. The rent just, home price went up a lot. I don't know if rents actually caught up to that fast. And they may run into DCR that doesn't meet. Then they'll put into our no docs program, like the old days, NIDA.
Yep.
The same thing, no income, no employment, no ratio, and we don't even need DCR. The place can be vacant even. These are the 3 hot ones we're selling.
Let me ask you a question. You talked about the VOE program early on. Now, in these types of markets where times push people to maybe do something they wouldn't do when times are good, right? And you're looking at documentation that comes in on these types of loans. Are you there? Oh, that's not good. Okay, very good. That was, I guess, Kim, either he lost or got out of range of what we were trying to do. So what I was trying to do is, here he comes right now. Hold on. Kim?
Jeff?
Hey, you there? Hi. We lost you there for a second. Are you there? Hello. That's okay. Just kill him. Asking him about the VOE program, the verification of employment for those people who are thinking, oh my God, what's going on over there right now? Well, the VOE is a type of verification process that lenders use to make sure that somebody who is employed is actually verified to be employed. And usually that is sent out by the lender and sent to the hiring manager, the HR person, whoever is in charge of payroll, and they fill out a form that says this person works this many hours, this person makes this amount of money, and I'll sign this and send it in. Well, in 2007, 2008, this VOE was really abused, i.e. anybody was filling it out and sending it in. There's a lot of fraud, and that's what I was trying to get to with Kim. How do we prevent those sort of things? And I wanted to get to the safeguards that AM West use, because I know they do, and to make people understand that this isn't like free money that, oh my gosh, that I didn't qualify for this, now I can qualify for this. But it does offer you a solution. The solution within the scope of what they're offering there. The other thing is these portfolio loans. Portfolio means they keep them. They don't sell them. They service the loans in their own book of loans that they have, which is really unbelievable because it allows them to be able to offer you all kinds of different programs that aren't necessarily available with Fannie Freddie type loans or Ginnie Mae FHA loans. This allows them to be able to say, hey, we're going to keep these loans on our books, service them ourselves, therefore we're allowed to open up the parameters by which you can get a loan. He mentioned the DSCR loans. Now, DSCR loans, as everyone knows, they're investment property loans. So TRID doesn't apply, meaning that this is an investor loan. You're going to put about 25, maybe 30% down on a property, and you're going to let the rents or the projected rents on those properties carry the loan. So you don't have to come in with income documentation. You don't have to come in with proof that you're actually making the kind of money in order to cover the mortgage on this type of investment property. Now, why is that important? Because in many regards, investing in small unit buildings, 5, 7, 10 unit buildings, and not having to, beyond the down payment, prove that you can pay the mortgage based on either your personal finances or your business or how much money you make, you allow the rents in the property to do that. It allows small-time investors to go out there in the marketplace and get rental properties. Rental properties, believe me, I talked to a guy today. I personally think rental properties for many people is a very difficult thing because they don't know what they're doing. And you can really get burned if you don't think about maintenance and if you don't think about management. But if you do, and this person was telling me about property in their particular group, they have a group of investors going around all over the country looking for unit buildings, anywhere from 5 all the way up to 100 unit buildings. Yeah, it's a great way to build wealth. There was a guy here in the Los Angeles area named Donald Sterling. He used to own the Clippers, right? They made him sell the team, but he built his entire billion-dollar empire on rental properties. Hundreds of unit buildings, all the way down to 4 and 5 and 6 unit buildings. So this is a great way by which, one, you can build residual income, 2, get out of the job you're doing and go full-time into this. And I think with what Kim was saying at AM West, these types of loans, these types of investment loans are just great. That with the VOE program that he had mentioned, which again is something that they do internally, they send out just the VOE. They don't check your tax returns. They don't check your bank statements. They don't check the income documentation. They just get the verification of employment from your employer. That's what they look to in order to satisfy that element of the ability to repay rule, which again is a great thing because what you're doing is you're narrowing the focus of what they need in documentation just to 1, 2 things in these VOE loans. So it's really terrific. Both of these are great. I wish we didn't lose Kim because he's a great guest. He's very knowledgeable, been around the business a long time, and he can really help. If you go to the website after this show, you could probably see him there, or if you don't, you can always call us here at the station or at the office. Email me as well. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to the Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show each and every week. We come to you, we bring you information on rates, we bring you information on programs, we bring you personalities and people who've been in the business forever, helping people just like you try to get a loan for either a purchase or a refinance. If you've been paying attention, and who hasn't, it seems like anytime we get near an election, everything is hyper, observed, and certainly the mortgage interest rates, inflation, the economy, gasoline prices, a lot of things are really, in focus on the negative, right? So to find your place and what you need to do in order to get a loan, and then once you get a loan to pay for the loan, this is what we do. And the show's about that, and so we bring to you people who can really describe what's going on right now in the marketplace. Jennifer Conrad joins us. She's a loan officer as well as a terrific processor, somebody who actually does two jobs within the loan itself, can give us a great perspective on what is happening. Jennifer joins us now. Jennifer, how are you?
I'm doing great, Jeff. Thank you so much for having me back.
And thank you very much for coming on the show. Okay, give us a little overview of what is going on in the mortgage industry. We've seen rates come down a little bit over the last couple of days, but what is happening?
Well, we still have a lot of primary resident purchases. It seems to be, again, a situation where lenders are coming up with certain things like some down payment assistance programs for FHA loans. The other thing we're looking at is more of an expansion on 40-year amortization loans,
right,
and interest-only loans, though those are more geared towards investor loans and even bank statement programs.
You talked about that 40-year. I saw that FHA came out with, hey, look, if you're in foreclosure, let's look at this as an option for an FHA loan, like a loan mod, except that you're going to now go to a 40-year. Is that also interest only, or is that fully amortized for over 40 years?
No, that's fully amortized, and we actually also have a lender that is offering for people who currently have a conventional loan. If you are in a situation, where you're needing to refinance, maybe, things got tight during COVID.
Sure.
They will allow you to refinance. They will pay for your appraisal. This is the first time ever I have seen where they have said that this lender says they will accept the loan with a 65% debt-to-income ratio. Normally, 43% is kind of considered the optimum. So
of course.
65%, and they will pay for your appraisal, and it's a conventional loan, and they understand, that you may have one or two 30-day lates over the past 12 months. So that is something I've never seen before in this business.
Is that a function of the market, meaning that there's so many loans that aren't there anymore that people are desperate for business? Or is this really somebody who holds the loans and is expecting to work with these borrowers if they get into trouble? I mean, it's with
Flagstar, so they are expected to hold the loan and to work with the borrowers. But I think the whole idea is to try to keep people from going into foreclosure.
Right.
I mean, we don't want to be in a situation where we have, all of these homes out there that are flooding the market, and the services are basically getting stuck, with paper that's not producing. So it almost makes sense that they're giving people an opportunity, to really try to do things to save their homes.
Yep.
I believe people inherently want to be able to pay their bills, and they want to be able to pay and keep their homes over their head. But unfortunately, we are going through a situation that none of us has ever really lived through it before. So it's like, trying to navigate the best we can.
We've got COVID still hanging over heads, and we constantly are trying to deal with what's going on in foreign affairs, whether it's over in China with the defaults or whether it's in Europe with the war. The economy looking like maybe or maybe not it goes into recession next year, the year after. It's a scary time for a lot of borrowers. What's the sentiment from the group that you're talking with?
I don't really think I'm seeing people necessarily afraid. I feel like, people are still trying to move forward, but it's more or less just trying to adjust. So it is a situation where borrowers are shopping to make sure that they're getting the best deal possible, because they do realize rates are up, but they also realize, that everyone is kind of wanting business. So that being the case, they sort of have a upper hand where they can say, hey, well, I have this offer and that's a little bit better, so can you meet it or beat it?
Yeah.
So it does mean maybe, in regards to with the rates being higher, there's probably less, that you can qualify for. So it's just a matter of, maybe changing what it is that you're going after, versus, maybe in the past where you might have been able to get a little bit more because you had a lower rate, so you had a lower payment, more expansion.
Yeah, I think lenders right now are open to a lot of different scenarios from a borrower, especially if you've got a fairly qualified borrower, whether it's on rate or whether it's, as you said earlier, maybe paying an appraisal or some other kinds of concessions that the lender might, because they need business, and you as the borrower are in a better position today with the lender than you were 6 months ago.
And, something else that I've noticed that has come out, which is actually quite interesting, normally we do loans that are the debt service loans where, for the investor loans, it's really based upon, you're qualifying based upon what the rent schedule on the appraisal is going to show as the fair market rent.
That's right.
And then that way you don't have to qualify with any of your current income. But it almost makes sense. We have a couple of lenders now that are doing a no-ratio loan for that investor loan. And I really think a lot of that has to do with the fact that we've had a lot of people who have not been paying rent. And then for some landlords who are now able to get people into rent, they may not be able to be collecting the amount of rent that they were collecting prior to COVID. So that rent is not going to equate to what the mortgage payment would be. So they have an option to refinance and do a no-ratio loan, and can do that with a 40-year amortization as well as interest only.
Oh, that's a great solution. And do me a favor, shout out your phone number. That's a great solution for people who have bought something of an investment property or in that situation. How do they get a hold of you?
They can call me at 773-593-6831.
Okay, very good. Oh, you are also in the market for a home. You're a buyer. When you're looking for homes, what are you looking for right now? Are you looking for availability? Are you looking for quality? Are you looking for location?
I'm looking for location.
Okay.
I'm looking for quality for the amount that it's costing, and I want to make sure that I'm going to get a good deal. I don't want something, where a seller feels like, it's their market, so they can, be overpriced with it. So I want to make sure I'm getting a good deal, and I want something that I know is going to be a good return on my money, because I'd like to know in a couple of years if I want to make this an investment property, or if I want to, sell it, that my value is going to increase, and that I'm not getting a piece of property that's going to require a lot of work that would end up being a liability more so than an asset.
Right. Do you think we're at that turn? Now, I read an article today, actually, that said, look, we're at a turning point in the real estate market. Do you feel that?
I don't think so. It seems like I'm noticing consistently, even if I've had a few where maybe the appraised value didn't come in with the sales price, the buyers are paying over asking.
Right.
They're agreeing to pay over asking. So it just seems like whatever the sellers are saying, this is what we want. If one buyer's not willing to do it, there are three others that are waiting to take it.
I see. So that contingency-free offer is still on the table for a lot of sellers in their minds. Yeah.
I'm saying that, and that's even with loans that are, I'm doing right now in Nevada, in North Carolina, as well as California.
Now, some of the ways that you solve problems for yourself are the exact same thing that you're doing for borrowers, right? I mean, you're out there, you're trying to not only get them the loan, but also coach them a little bit up on as to what might give them a competitive advantage. What are you telling them to give them a competitive advantage in this type of market?
Well, I always like to know that my borrowers are going out not with just a pre-approval, but if I can provide them with a full loan commitment from a lender.
Right.
If not that, then what we call automated underwriting findings, because anyone can have a pre-approval that just says, a loan originator has looked at, this information and you qualify. So I feel like it sort of gives them a leg up because then the seller knows they really, truly have been qualified. And it also means we're looking at closing in like 30 days or less. The other thing is, if there are any things on the credit that we need to address, that is going to increase the credit and make it really solid assets, whether it's personal assets or gifts, so that when we submit the file into the underwriter, that we kind of have it so they touch it once or twice, everything is super clean, and then they'll go ahead and move us through. So, in those ways, I try to coach a borrower to make sure that they're ready, prepared, and hopefully we'll be able to land on their deal that's best for them.
Jennifer, excellent information. Thank you once again for coming on the show. I really do appreciate it. And shout out your phone number one more time for people, please.
Thank you for having me, Jeff, and it's 773-593-6831.
This is Jennifer Conrad from Malibu Funding, loan officer, processor in many different states across the country. Jennifer, thanks again.
Thank you.
Thank you. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. We can be heard, seen, and those two things. You either go to YouTube and watch Jeff Barton, the Mortgage Voice, hundreds of shows there, certainly the latest, as well as going to LinkedIn or Facebook and just look up Jeff Barton, the Mortgage Minute, and you can see me there. And we usually do 2 or 3 of those a week. We try to inform by bringing great people to the show, people who are account executives at certain different lenders themselves, all kinds of experienced loan officers, people who have been in the business a long time to provide solutions to you. I know it sounds like a commercial, but it's not a commercial. It's the truth. People that come on the show really know what they're talking about. And with the market the way it is, and everybody knows rates have gone up, they're continuing to go up, even though we had a little reprieve in the last 4 or 5 days. They're probably going to go up, and I predicted, I don't know whether this is going to happen or not, but 6.5% by the end of the year. Just seems to me the way it's going. Anyway, who knows more about it than me? This next guest, Wendy Van Wessel, comes to us from Kind Lending. Wendy, how are you?
I am just fine today, Jeff, and yourself?
I'm fine, thank you. How do you like my predictive capabilities?
I think you're spot on. I think that we need to be more creative now. We have programs now that are coming out where borrowers that couldn't qualify before can now qualify. It's just a little bit of what you call sticker shock.
Yeah.
They were used to high 3s, low 4s, and now it's creeping up into the 5s, mid 5s, and if you go non-QM, which is the non-Fannie, Freddie, or Ginnie Mae, they're even higher, but they do offer 40-year interest only. So they're thinking of ways with which to qualify you with the higher rates that are here for a while. I agree with you. 2 half-point raises are going to come. Another one's going to come next month, and they're going to stop buying mortgage-backed securities and sell off what they have. So it's not going to go down anytime soon. Maybe a little dips, like you said, the last couple of days, but I don't see it going down to where it was.
No, I think
in the near future.
Well, realistically, 5% is a pretty good rate. I mean, historically, this is about as low as it gets. I mean, we really rarely have ever seen, in my lifetime anyway, 2.5% mortgage. I mean, that was just really amazing. And I still know people who never refied. Talked to a person the other day. Oh, I had 5.25. I said, well, where were you? You've been asleep for 3 years? What have you been doing? I don't know. I just didn't get around to it. I've been busy. Busy? Really? Think up the money? Anyway, I can't get into it. Okay, so you talked some about the 40-year. The 40-year was a product I'd never even heard of till recently. And I've heard even 40-year interest-only type products, and I've never heard any of this. Why is that? Go on.
The non-qualified mortgage, which is Glenn Stearns had the Stearns Company. A lot of the good people with him. But his vision or his thought is that in the future that we will be going after non-qualified mortgages, non-QM mortgages, meaning that you can do just your bank statements because you write off too much on your taxes when you're a self-employed borrower, meaning that you can do just a P&L, or you can do credit events like a short sale within the last 12 months and you can still get a loan. There's also the DSCRs. If you want to buy an investment property and your rental income covers your payment, then that's a good thing to have. But with a 3 to 5 year prepay is going to be where you have the rates that are decent. So those new programs opening up, and that includes all of those programs offer that 40-year interest only that you were talking about. So interest only for the first 10 years.
Okay.
And with the DSCR program, sorry, go ahead, I interrupted you.
What's that?
Did I interrupt you? I'm sorry.
Not at all. No, I'm just humming along here like I know the tune.
The DSCR, where the rent pays for a non-owner occupied property, the mortgage payment. They offer the 40-year interest-only program. It is qualified off the 40-year interest-only payment, and your reserves are also qualified off of that interest-only payment. That is the non-QM 40-year interest-only. After the first 10 years, they take that same rate, and then they divide it up over the next 30 years.
Now,
so that's a pretty good loan. Go ahead.
No, I was going to say, is it because the monthly, the amount that you're going to pay on your mortgage on a monthly basis is a lot lower, and that's why the 40 years is being sold?
Yes, because it's not the rate, because the rate probably is going to go in the sixes, right?
Right. No, it's going to be amortized over 40, so your payment's lower.
Yes, exactly right. And that interest-only payment for the first 10 years, and then the rate doesn't increase a whole lot. God knows what will be then in 10 years. With
no idea.
But you'll have at least that rate for the next 30 years.
It's interesting. So we look at employment, and we look at how people are going to repay. In these hybrid type newer loans, what happens to the ability to repay? What happens to that whole rule? Is it out the window because it's non-QM portfolio type loans, or how are you guys addressing it?
They are different from Fannie and Freddie, but Fannie and Freddie are going to change too, because are they going to continue to buy mortgage-backed securities?
No.
We don't know.
Well, yeah, I don't know. They were reinvesting. Didn't they stop reinvesting too?
Yes, and they were going to sell them off too.
Right, and now they're going to sell them off, right.
Right. So you have investors. They're not REITs, which are people that get together with the money and then I like the idea of loans.
Yeah.
But they're different types of investors, and you pool and sell loans on how they're going to perform. Everybody wants to say, okay, a savings account gives you 2%. Well, look at these mortgages with these good qualified borrowers.
Right.
They're going to give you back 5% on your investment. That's how they do it with the different investors. So they're looking at their ability to repay, yes, but not as strictly as those government Fannie Freddie rules were, with the 2% max cost. Remember that 3%
yes.
QM rule?
Absolutely.
So those are different. We also have jumbo arms. So to help with rates on jumbos, the jumbo arm is like a 7/6 arm, and it was a rate in the high fours for a $1.5 million loan, which is not too bad right now these days.
Yeah, I've got it 4.5% on an ARM product, and I had one of these questions down here talking about ARM products. Are they now going to be back in vogue, even though it's a short term, but you can at least get in on an opening rate for 4 or 5 years, maybe 7 years?
That's exactly right, so that the borrower can qualify more. But they're not, the spread between the ARMs and the jumbos right now is still not as big as it once was.
Right.
Maybe it's a couple of points, maybe it's 1.5 points, but sometimes that helps to make the loan work. But they're coming, and I don't like the 10/6 arm yet, but the 7/6 arm looks good in helping to qualify more borrowers for those loans, those jumbo loans. But
what's a 7/6? I'm sorry, I'm ignorant.
7/6 arm.
What does that mean?
7/6 arm means that it's a 7 years fixed,
right,
and that it adjusts every 6 months. That the max that it can adjust is the 515, right? The max it can adjust is 5 points.
Okay.
Yeah.
So if you get in at 6, max is 11, and it adjusts every 6 months. Now that, we've seen adjustables really be very low over the last 5 years, maybe 10 years, ever since 08, 09. Do they?
It depends on what the market does.
Yeah, right,
they're
exactly.
With the market, just like your HELOC loans are going to do the same thing.
Right, and those particular loans, the adjustables are tied to what rate? I mean, since we don't use LIBOR anymore, what are we using?
SOFR.
Okay, right.
SOFR.
Right.
Isn't that the New York Stock Exchange?
Yes, it is. I think that's right. I think that's exactly right. And now, we try to educate here on the show, but trying to figure out what indexes, rates, and margins are being used on what products is maddening. So suffice it to say that if someone wanted to get into an ARM product, those types of people would probably be best suited to look to short-term investments, selling them off before, or refinancing before the term comes due. What are you recommending, or what do you think?
Well, for history, right, when you get all those classes and everything, they say arms are for short terms for the fixed period when you know that you want to move. You want to live here in this house for 5 years, and then you want to sell it, and you want to go to Tennessee or Alabama or wherever everybody's going to. I'm staying here in California, though, by the way.
I like the weather. I know.
I like the weather. I like the state. I'm staying, dang
it. That's very funny. Okay, well, all right, so predictability. Let's get into what we have about a minute left. What you think, product-wise, is in the future that has not really hit the market.
I think that, and it's going to, the things that the non-QM loans are going to be pretty good, especially with what's going on with the government. We have the VA and FHA loans that are still good loans. I do not understand why the people that are listing their homes don't like those loans. Borrowers are qualified. Maybe it's less skin in the game, but they are qualified borrowers, and they're good loans, and we do them very well. We have to say.
Well, yeah, I think the market turns around when FHA buyers become attractive, right? Then we know, okay, it's a buyer's market. But until that time, the cash buyer is going to rule, and certainly somebody with a pre-qualified, 20% down is going to be more attractive to the seller.
That's another thing we're going to do. We're going to be doing to-be-determined approvals so that the borrower gets approved and they don't have to get redone every time they find a new property, which is one of the 5 pieces of information that makes a loan.
Excellent. Wendy, we're up against it. Shout out a phone number for people to get in touch with you, questions about some of the products you brought up.
818-292-2572. And thank you, Jeff, as always.
Thank you. Wendy Van Wessel from Kind Lending. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. And, we are on a number of different podcasts. We talk about our radio stations, we talk about YouTube, but our podcasts are huge. We're on, John, do you happen to have a list for me?
Oh, we're everywhere, Jeff.
Thanks.
We're on Apple Podcasts and Google. We're on Spreaker, Stitcher. We're on Spotify.
Yes.
We're on iHeart. We're on, on those guys at podclips.io.
Love those guys. Yeah. Podclips.io. Okay, if you're looking for a spot where you don't have to shop around and find out great podcasts, this is where you got to go. Podclips.io is a new podcast sort of house where you go, you look up different categories, whether it's lifestyle, mime and finance, there's sports, there's cooking, all kinds of things there. Great people, good people to listen to, and it's an interesting way by which you can spend a couple hours every weekend. I'm Jeff Barton. This is The Mortgage Voice. Again, go to themortgagevoice.com. That is our website. We are there. Our guests are there, and that's where the house that we call the Malibu. What do we call this? We call this the mortgagevoice.com. That's where we house everything about the show. Go there, sign up, join in, and have a good listen. Anyway, thanks very much for listening. I'm Jeff Barton. Again, we are in the news to use section now. When we divided up the show early on, I don't know, about 8-9 years ago, we have hundreds of shows at the YouTube site if you want to go back and archive any of them. It's interesting to see where we were, where we are now, and possibly that's a good way to see where we're going to be heading. But in those days, back in the early days, we used to do some things on the show. We did a segment called News to Use, and so I drag it up every now and again just because there are some elements in the news that you need to know about so that you can make some better decisions. All of these things that we talk about on the show affect your mortgage rate. Now, we talk not esoterically, but certainly in a vague way, why the economy, why Ukraine, why inflation, all affects the mortgage rates, whether it's driving people to the Treasury market or whether it's driving people away from the Treasury market. All that happens to do that affects your mortgage interest rate. And as everybody knows, if the yield falls, so does your mortgage interest rate. And that's a good thing. So if you're watching the 10-year, that's what you got to do. Watch the 10-year. Now, if the yields rise, that means that they are also discounting the Treasury yield, which means that your mortgage interest rate is going to go up. Yes, it's kind of an inverse relationship. Not easy, but again, just watch the 10-year. If it goes one way, your mortgage rate's probably going to go that way too, okay? All right, housing. New home sales, really off. Now, what is this a function of? It's a function of the rates going up. The rates going up have killed the new housing market. Now, since '08, let's go back, drift back a little bit. Remember '08, right? They were building crazy. I had friends of mine down in Arizona just, oh man, they were so excited. Oh, Arizona, it's the fastest growing housing market in the country. And, you know, they had crews just rolling through and building houses. I had a project down there. Oh, Orangewood Development Company was a company that I had. It was when I first started into real estate. Oh, this was in the early 2000s. And we were just going out, finding dirt and building the infrastructure and then selling it to a builder. That's a big business. And in those kind of markets, that's exactly what was happening at that time. Now, it was happening there, it was happening in Vegas, it was happening in Florida, in Utah, in Michigan, all over the country. Well, they're not doing that anymore. And the reason why is because they got burned big time. Those companies that were doing that, Pulte, KB, I don't know, Aspen, there's any number of major home builders out there who just lost their shirts. So what they're doing right now is they're trying to build on demand. And if we have a slowdown in purchases of new homes, it kills demand, which means they stop building or they stop going to build. They don't look at projections of population growth and what's needed. They look at the bottom line. Can we make money on this deal? And I think when that happened, and I can point back to 08, 07, 08, when the housing market actually crashed, as the exact time that the flip on what was happening in the housing market. They used to spec these housing developments. Just build them. The people will come. That's not what they do anymore. Unless they can see that they can make money based on the demand. And now, what is the demand, and how does that formula work? I don't know. But I do know, and I have people who are small builders who are, worried right now. Why? Because we see the real estate market changing. Now, is it going to change overnight? No. Are we going to have a drop in prices like we did back in '08? No, I don't think so. But there is every chance and possibility that the value of your home over the next 2 years will drop. And the expectancy on that on new builders is, hey, if that's happening to existing homes, why am I building new homes when costs are going up, even though lumber costs have come down a little bit? But as we all know, costs for anything building material-wise has gone up anywhere from 15 to 50%. So that really kills the want to go out there and build for big builders. So therefore, new home sales are off, and they're going to remain off for a while probably. Mortgage rates are up. That's the other reason that we're talking about why the new houses aren't selling. Mortgage rates are up. So every percentage point that goes up in the mortgage interest rate, you're killing off about 1 million to 2 million people who can't afford to buy that house anymore. And that's just the reality of the way it is. Let's see. This is okay. So there are 4 different reasons, according to this article that I read, and I printed it out, and I want to discuss it here. 4 reasons or 4 things that are going to happen in the real estate market. We can talk about them a little bit. Let's get right to it. Okay, so this is prediction number 1. Okay, inventory shortages mean home prices may keep rising. Okay, I think that's true. But I also think what is true is that if interest rates rise too high, you will kill demand completely, and therefore there's usually a 6-month lag between something happening and prices changing. And therefore, I'm thinking, okay, so 6 months from now, what is it, October, November? That's when you're going to see softening in prices. You've already seen the real estate inventory in many, many places rise, which is a good thing. Number 2, cash buyers are still playing a big role in this housing market. Over a third of the houses bought in the U.S. are done by cash. You think there's a lot of money here? Oh, my gosh. And everybody knows that the home prices have gone up 25, 30%. Now, I talked to a friend of mine, and she tells me that she has a 5.25% mortgage rate on her house in Atlanta, Georgia. And I'm thinking, okay, we usually have LaWanna Bradford come on and talk about prices and way it is. And a lot of markets in the United States, you can still get a house for a reasonable price. So I asked her, I said, okay, so you missed the market. You didn't get in. Your mortgage interest rate is 5.25, and you've paid 15 years already, so you got another 15 years to go. So anybody who does that calculus will probably tell her, look, it's not really worth going to a 3% rate to save the money in order to, you'd probably need 10 years worth of payments in order to save any money. So really just pay out what you already have, because that's probably what it's worth. But she was telling me that her house was worth $250,000. She owes $100,000 on it. She wanted to take some money out or do some kind of a refi. So I'm like, oh, well, that's not too bad. But she's in Atlanta, Georgia. She's, middle income person. In many places in the U.S., this is what home prices are. It's not like crazy California or cuckoo New York or down in Miami or down in Dallas and some of these other places. You can really look at these numbers and say, yeah, that's affordable. Take Albuquerque. We had a guy on a couple of weeks ago talking about how Albuquerque prices were $350,000. And of course, being Mr. Dumb Guy from Southern California, I'm thinking $350,000. Shoot, my garage costs that. But that's just the difference. In that market, $350 is expensive because 3 years ago it was $250. So, number 3, demand will remain high. Well, we all know that's true. Even though the buyers may be priced out of the market, the demand is still there. So, if there's a bit of a falter in price or in mortgage rates, you're going to see more buyers. And the number 4, I feel like, what's that game show? Okay, so number 4, here we go. It would take a big event to send home prices plummeting. Yes, that's true. In 2008, what was it? It was the implosion in the mortgage market. Signature loans, bad loans. That's basically what it was. But in this particular market, you're going to have to see external forces or, one heck of a natural disaster. Now, we've seen fire season already kick up in many places in the U.S., more so than we already have. But since we're used to it, at least over the last 5 years, I don't know if that's going to be the catastrophic events that's going to drive housing. I think it's going to be the steady rise of mortgage interest rates, which will price out more and more people, and fewer people can buy, and that's when you're going to see house prices come down. Now, will they collapse? No, I don't think so. Too much demand, not enough houses being built, as we've talked about in an earlier segment. Anyway, that's the way it is. I'm Jeff Barton, your voice in the mortgage industry. Really happy and glad you listened to us this week, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
Miss your favorite show? Download the podcast at KCAA.